40, 20, 26 is our pivot. The resistance at 39, 50, 61, 72, 84. Support below at 15, 06, 39.93, 84, 74. Pivot 26, 40, 26, support 15, 06, 39.93, 84, 74. Resistance on the upside at 39, 50, 61, 72, and 84. All right. All right, so let's see what happened. So the pivot 26, resistance at 39, 50, 61, 72, 84. Support 15, 06, 39.93, 84, and 74. All right, let's see what happens here as the market opens up a little bit quickly, coming up here to our 39 area. Again, be careful here as the market's very slippery, going to be a little bit slippery here. But just keep your stops in place and trade it accordingly. All right, coming right up there to that 39 area and giving us a nice little quick rotation off of that. Obviously, you have to be a little bit, you have to have the orders in place there, but nice quick rotation there off of our, definitely about 4 to 5 points for sure in our stops on our entry points. So we did get right up to 39, came down there to 34. So a nice little rotation there off of the 39 area. We're going to get some fast rotations here, complaining about how slow it's been. Well, it's not going to be slow today. And there they are. There are the levels in the chat for those of you who might have missed them. Came right up to our 39 there and rotated quickly off of it. We'll see what the market wants to do. Next level of resistance we have is up at the 50 area. Anybody have any questions, feel free to ask. We are scalping mini S&Ps here, looking for opportunities to scalp around these levels that we just gave out. In addition to any price action opportunities, we've had a nice rotation there against our first resistance area. Obviously, resistance means a little bit of a sale there against the areas that are resistance, right? So that was our first level of that we were focused in on. We'll see what happens if it continues to rally here. We've got the next level that we have that we're looking at is up at 50. Again, the number was very good in regards to the unemployment number, which again is what the Fed looks at, which again counteracts what Jeremy Powell said this week. So we're having this divergence in pretty much given up bond market, pretty much given up a lot of the yields that it started out with. So you know, there's that for you. But still doing pretty good. Unemployment rate came in at 3.7, and that was what was expected. Average hourly earnings, which is an inflation gauge, they were expecting plus 0.3, came out at plus 0.6. So we have wages going up, counteracting, you know, again, that's putting money into the economy. So consequently, you're getting nervous about that. Hourly earnings, average hourly earnings year to year, expected 4.6, came out at 5.1. And last time was 5.6. So again, better than last month, but again, they exceeded expectation, and those are inflationary kind of. That's what the thinking is, and that's why you have. But also, like I keep saying, it could lead or could inch your way to that fact that it could lead to a soft landing if everything is under control, right? I mean, I don't know. We'll see what happens. All right. Market is staying a little bit strong. Next level resistance we have is up at the 50 area. You can see our blue band coming in there at the 47 change. The unemployment numbers keep, beating expectations. But we are at a loftier level than we were, obviously, where we started. So again, it's pretty, even though we are giving back a little bit, considering the rally we had 2 days ago, you can see here, it's still within that rally, so it's not, it's still kind of hanging in there with what Jeremy Powell said, or Jay Powell, I guess. Who knows? All right, market is just kind of hanging here. It got right up to our blue band area there, got up to the 43, 44 area, and then come off. You could see our blue bands in there at 45. And if anybody has any questions, feel free to ask in the chat.
Hey, Saul.
Yes, sir.
Was you around yesterday afternoon about 2 o'clock?
No, I was no.
Reason I ask is that I was doing a YouTube video on my other screen, and I just wonder if it was feeding back through the room.
Yeah, no, I wasn't. I wasn't here. Maybe Brad was here. Brad?
No, he wasn't here. I asked him.
Oh, yeah, he wasn't here either. I don't. Again, we leave the charts up, but hopefully, if people make money, they're out of here.
Yeah.
So that's a good thing. I was running errands yesterday. I had to do some stuff with my car, take care of my car, because every now and then you have to take care of your car, especially before winter time.
Yep.
All right, so there we go. We're popping up here. We're looking at the 50 area here as some next level of resistance. Again, it's kind of retracing that big bar off of that number, so it's very light volume here. So be a little bit mindful of that. Got resistance at the 50 area. Keep your stops in place no matter what. Got a nice rotation there against the 39 area. Now we're slowly continuing to retrace as the bond market kind of retraced a little bit of their losses. Let's see what we want to do here against the 50 area if we get a chance. I don't know if we're going to or not. And if anybody has any questions, feel free to ask in the chat. Nice little recovery here in the market. Again, bonds are also recovered very nicely. And we are still having a big divergence in the yield curve, which is causing a little bit of a problem. But today, the yield curve is kind of getting more in line here. The 10-year is down 18 ticks, and S&P, the 30-year is only down 15. So short-term yields are going up, but not. Let's see, the long term is not going up as fast. So we were at the difference between the 2s and the 10s were at 80 basis points. Very again, the bond market telling you one thing, the market telling you another, right? So The bond market, again, has a history of being right. So we have to be, careful of how we, what's going to happen in the future, right? Again, that's why this time is very interesting, because again, the numbers are good. GDP, which is good. These unemployment numbers are good. But the bond market's telling you we're still going to go into some kind of recession. So it's it's a weird kind of moment, right? Hard to see what we're doing going forward. As far as the bigger picture, as far as we're concerned, we just like the volatility, right? That's all we care about. As we came up here to the 47 area and then came back off, we were looking at 50. So if we get back up there, be a little bit careful. Let's see, on the downside, probably looking at the pivot here as a little bit of support if we get back down there. The release of November's non-farm payrolls was expected at 7:30 this morning. Expected to show job growth to continue to slow as the Fed aggressive rate hike path starts to rein in consumers and business spending. Not the case. Economists expect 200,000 job growth, but came out at 260 something. Will be added during the month, down 200 from 261,000 in October, while the unemployment rate is expected to stay at 3.7, which is it did in near a 50-year low. Some of the recent economic reports back up the expectations for slower increases in jobs, the ADP November report, the JOLTS October report, and an increased number of firing announcements. I guess it's going to take a little bit of time to come back into I don't know, see what happens. Let's see, high profile layoff surge through the U.S. tech industry. The broader private sector is still creating jobs, but at a slower pace, while jobs openings are still high, said some analysts. And these factors imply that the Federal Reserve tightening campaign is helping to slow down the economy and inflation, but the challenging war against increasing prices is far from over, which again is those numbers that we talked about in regards to wages. All right, market down ticking here a little bit, looking at support right around our pivot. And if you look at the chat, you will see the levels we gave out this morning. They are going to guide to the day. We came up to our 39 area and came off of that very nicely. Proceeded to come up here to 47 and change, and then come off here a little bit. And now we're going to have to be a little bit careful up there at 50. If we go back up there, maybe adjust a little bit number of contracts you trade or where you get in. If we get back up there, or if you're more risk averse, you're not going to take the trade at all. Indeed, traders don't see the Fed pivoting anytime soon, though the Fed's officials have been indicating they're betting on a smaller rate hike going forward. The CME Fed Watch, but a 75% basis probability, I should say, on a 50% basis. On a 50 basis point increase in December, 78% chance on the December 13th and 14th meeting, and down from the 75 basis point hike at each of the past 4 meetings. For February meeting, traders are seeing a 42 48% probability of 25% basis points, and it puts the odds at a 50 basis point hike at 43%. So basically, they're not looking at 75 basis points in the next, what is the next one? February. So no meeting in January. Hourly wages, workers' average hourly earnings are expected to increase 4.6% year to year, easing from its 4.7. Again, that's the problem, that the wages have stayed pretty strong. Wage increases are probably going to be a very important part of of the story going forward. Fed Chair Powell said on Wednesday, of course, we want wages to go up, but they're constant with the goal. They have to be consistent with the goal of 2% inflation. Well, that's not happening. All right, we got down to 33 there, and then pop back up. Again, I said that we had a little support down at 26. The most important thing here is to be a little bit patient here, kind of let the market kind of give us our opportunities to trade, and pick good areas that we feel maybe they would work. And if they don't work, we have our stops in place. And it's kind of easy to want to jump in and start trading when it's flipping around all over the place, but it's very hard to kind of decide where it's going to stop. But at least if we can find areas that we believe markets should have some support and or resistance, will give us a focus on that area to trade, versus just jumping in here with not much to look at, or just guessing where it might stop. It's not what we try to do here. And if anybody has any questions, feel free to ask in the chat. We are trading mini S&Ps futures, looking for opportunities to scalp the market based on the levels we gave out. And like I said, if you looked at the chat, you'll see those levels. And then once the market opens up, there are price action opportunities that occur. And like I said, we have to be patient and kind of wait for them. All right, again, the support that we're looking at is the pivot there at 26. So we'll focus then a little bit there, see what happens from there. Otherwise, it's kind of hard to, every time they have it, kind of hard to you have to be patient and wait. It seems like we're kind of following the bond market here a little bit. Bonds are kind of turning over to a little to the downside, and we kind of seem to want to do what they're doing. Looks like that chart in the S&P is kind of mimics the bond chart a little bit. The bond chart is the chart on the left there. It's a 30-year bond chart that we have up there. All right, market just popping around. Very tough to figure out where it's going to stop. We're looking at the 26 as a little area that we'll focus in on. Otherwise, let's be a little bit patient here. It's definitely choppy. You want to find a good opportunity instead of just jumping in. Again, if anybody has any questions, feel free to ask in the chat. See if there's any other numbers coming out this morning here at 9 o'clock. Nope, nothing. Let's see, I guess there's still Fed speaks at 9:15 and then at 12. So 9:15 and 12. Those are a couple Fed speaks that are going to be occurring. And the Senate has passed the bill by a 80 to 15 margin that will avert a rail strike one day after it passed in the House. The measure now goes to the desk of Biden, who had urged Congress to act quickly before the December 9th strike deadline. The legislation enacts a new contract that provides railroad workers with 24% increase in wages from 20 through 24, immediate payouts averaging $11,000 upon ratification, as well as an additional paid day off on top of the existing vacation days. By some estimates, the railroads impact about a third to about 45% of all freight in the United States, meaning a strike could trigger a knock-on effect of many industries and becoming another inflationary threat. It would also likely cost the nation $2 billion of economic output per day if the rails, if things went off the rails. That's funny. To prepare for a shutdown, railroads even stop accepting security-sensitive shipments such as chemicals and to treat drinking water. Well, that's good to know. There's no way they're going to let that happen. Bonds are kind of giving it all the way up here, and at least the 30 years are, and they're not as much. Again, the yield curve is the problem there in the bond market in regards to the economy. Yeah, well, I don't know. Gold lost its luster. I don't know. Yeah, I mean, it used to be an inflationary hedge, but I don't know. I guess it hasn't done anything this time around. The gold situation there. On that gold market. Let's see, is there a price on gold that we have here? Gold is at 1,800 and change an ounce. I think that's where it's been at for a long time. All right, continue staying a little bit strong here. Again, very choppy little trade here. Kind of just bouncing back and forth. Kind of hard to figure out where it's going to bounce from. I'd rather find an area that I believe will work for us instead of just guessing here where it's going to bounce around. And usually get yourself in trouble if you just kind of want to jump in. Every time I want to jump in, it just seems not to work out for me. So I'll just wait. I got 26 downside and I got 50 up there. But like I said, if you're more risk averse because of where the market ended up there a little bit ago at 47 and change, you're going to be a little bit mindful of the 50 area, depending on how risk averse you are. And everybody here has different risk tolerances, so not everybody here has to trade the same way. VIX got a 19 handle. Wow. All right, very, very choppy here. Got up to 42, come all the way back down, just chopping around. Kind of hard to even play the range game because it's in a weird range. All right. We're just chopping here. Be patient again, like I said. All right. It seems like we want to try to uptick. We're looking at well, 50 area, a little resistance up there. Again, adjust because of the price action just prior to that. See where it wants to go or what it wants to do up there. Bond market kind of now is doing their own thing. They're on the lows. We kind of stopped following them a little. Kind of hard to. They kind of just did. They kind of did pull the plug here on this market. They were did that quick move, and then boom, just nothing. And then it just gets in this little range here. So again, I've said this about unemployment. You get the big move, and then they just kind of unfortunately do nothing the rest of the day. Let's see what happens here. The VIX normal times. Normal. It's a tough question. At what point, when I don't know what normal is anymore. That's the problem. That's why I'm hesitating to answer that question. What is the VIX at normal times? I think if everything is known, and which way the markets are, and for the most part, good news is good news, bad news is bad news. The market can react to that. You're not coming off of highs. You're not worried about getting back into a bull market or not. You're not having these recession times. If everything is at maybe a VIX in the high teens, is normal, is what could be. I would assume for the longest amount of time, it was the 10 to 12 range, where we had S&P ranges of about 15 points, 10, 20 points in a day. Those days, I think, were normal, and I don't think they're going to come back anymore. Not with the volatility in the markets anymore. Not with when it does get into the teens, it definitely is. It's a much quieter trade. It's not as volatile. You have to be patient though and pick your spots. You don't get the quick moves that you're used to if you were trading. If you were trading with the volatility that's there, you have to be a little bit more patient, pick your spots a little bit better, and then see what happens. So, so the high teens, I think right now, if we get kind of back to normal, again, that's the key word here, because I don't know what normal is anymore. Like I said before, I think we could. There was a time where we had much saner and slower trade, and we could definitely say it was normal for the longest amount of time, but not anymore. So again, tough question to answer. I think the new normal, let's put it that way, Yeah, that's what I want to say. Finally got one. The new normal would probably be in the high teens. I don't know if we're ever going to get back to 10 to, we were the longest amount of time to 10 to 12, the longest amount of time. So but definitely, I think there's probably a new normal, and the new normal would probably be probably in the high teens. Again, for those of you who might have just come in late, if you look at the chat, you'll see the levels. We can use those as a guide to the day, and they're good all day. Obviously, you have to consider price action, like this 50 area here is a little bit not as strong as it was when we started, only because we got up to 47 and change up there and then retracted here a little bit. And now we're just kind of floating back and forth. So you have to be a little bit careful there around the 50. So that's you have to consider the price action is what I'm trying to say. But if you're going to use those levels all day, you could. And kind of use them as a guide to the day. But we've added to them yesterday. I added some levels and completely market completely turn around, went the other way. I do it every time. I know how to stop a market every time. It's amazing. I give you more levels to the downside, and all of a sudden we that was it.